This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. We often talk some big numbers in this podcast, from $700 billion in capex spend by the US hyperscalers just this year, to the $86 billion raised by SpaceX when it IPO'd in June. And last week, the number that stood out was even larger, $40 trillion in fact. That's the outstanding debt of the US government. While it's a big number, it's forecast to get even bigger. So to discuss debt levels and more today is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
Tracey, we spend a lot of time talking to clients and advisors about what's happening in markets, but I thought today we might turn that around a little and talk about what they're asking us. There's a couple of subjects that seem to come up repeatedly at the moment. It's inflation and the Aussie dollar. But before we get onto inflation, you had an interesting conversation with a client recently that got you thinking about risk more broadly.
I did, yes. And strangely enough, it started with motorcycles rather than markets. We were having lunch with one of our clients recently, Ed, you and I actually last week, and it was very nice. And she asked me about my riding. She mentioned that she'd been a nurse and that she and her husband had always discouraged their boys from riding motorcycles because she'd seen the consequences when things go wrong. And I've heard that before, particularly from people in the medical industry. And, you know, she's right. Riding a motorcycle is risky. It got me thinking that almost every sport, in fact, almost everything that we do involves some kind of risk. The interesting question isn't whether there is risk. It's how you behave in the presence of that risk. And I think it takes a certain temperament to be a good motorcycle rider. You can throw caution to the wind, you can weave through traffic, ride too fast, take corners too aggressively and get an enormous adrenaline rush from it. And you might get away with it, but you can push your luck. Or alternatively, you can be a very different kind of rider. You can be considered, calm, conscious of the conditions around you. And I want to be the kind of rider who is going to be around to ride another day. So I do things to manage my risk. I can't eliminate it. The only way I can eliminate the risk completely is to not do it. But I can manage it. I ride to the conditions. I don't weave in and out of traffic. I leave myself room to respond when something unexpected happens. And most importantly, I try and keep an even temperament. And I actually think investing is remarkably similar.
Tracy, I feel whenever we record a podcast on a Monday, it starts with a motorcycle story because you went for a ride on the weekend, and I guess why not given the weather? But tell us more about this idea though. And do you think there are good riders and bad riders in markets as well?
Yes, I do. You can take some crazy risks in a portfolio. You can put a large amount of money into something incredibly speculative, you know, a tiny biotech company or a cryptocurrency nobody had heard of 6 months ago. And occasionally you'll make an extraordinary amount of money. But we need to remember one of the most fundamental principles of investing, outsized returns don't come without outsized risk. Sometimes the risk simply hasn't revealed itself yet. And that's an important distinction because we have a tendency in investment markets to judge a decision by its outcome. If somebody takes an enormous risk and makes 50%, we say, what a great investor. Well, perhaps. Or maybe they were simply a reckless rider who happened to make it around the corner without oncoming traffic. One of my favourite sayings is, just because you got away with it doesn't mean you didn't take risk.
Tracy, how do you tell the difference between a good investor taking risk and a reckless investor who just got lucky?
Yeah, I think it comes down to whether the risk is conscious and deliberate. A good investor takes risk. They have to. That's how we generate returns. But they understand the risk they're taking. They understand what could go wrong. And importantly, they make sure they can survive if it doesn't.
And presumably that means there'll be times when the more reckless investor actually looks like the better investor.
Well, that's right. And this is where temperament comes in. There will always be moments when somebody goes past you, another rider travelling fast, another portfolio producing a higher return. And the temptation is to accelerate and chase them. But you have no idea how much risk they're taking to achieve that return. One of my favourite cricketers was Steve Waugh, and my favourite tennis player was Steffi Graf. What I loved about both of them was their temperament. Nothing seemed to faze them. Waugh would walk into an incredibly hostile environment with the match going against Australia and somehow look exactly the same as he did when Australia was dominating. And Graf was similar. She could lose a point, even an important point, and there was very little visible reaction. The great sports people aren't emotionless, of course, but they do know how to control their emotions when it matters most. And I think the best investors have exactly the same attribute. They're just even-tempered. They don't suddenly decide risk doesn't matter because markets have gone up for 6 months, and they don't sell everything because markets have fallen 15%. They remain conscious of the conditions around them.
So, Tracey, what are the conditions around us today?
Well, that's where inflation becomes important, and this came up in our conversation last week because I think the conditions have changed in that regard. The world that we knew was one where globalization was lowering costs. China was adding hundreds of millions of workers, cheap workers, to the global economy. Energy was relatively abundant and governments were generally fiscally prudent. Interest rates were trending down. Whenever the economy got into trouble, inflation tended to fall and central banks could cut interest rates. That meant that government bonds generally went up when equities went down. Bonds were an important shock absorber. But today's conditions are different. We're dealing with a world in which supply is becoming constrained or is already constrained. The geopolitical situation is just one representation of that. The US has used 1,000 Tomahawk missiles in the Iran war. It's estimated it will take 4 to 5 years to replenish those missile stockpiles back to pre-war levels. Now, replenishing those stockpiles will consume a lot of scarce resource.
Makes inflation harder to get rid of because the constraints on supply negatively impact growth.
Exactly. You can't sell something if you can't produce it. This is where I think the riding analogy becomes useful. If you're riding a motorcycle and the traffic around you starts to build up, you have to slow down. That's what the economy is doing. It's slowing down because the congestion in supply is so great. These are the kinds of conditions we consider when constructing portfolios. And that means being prepared. And in today's environment, it means being prepared for all kinds of conditions because they can change very quickly. You know, Liberation Day came and went. Greenland came and went. We don't mention North Korea much anymore. It doesn't mean that these issues are out of the picture entirely. They may just be sleeping. Portfolios, though, need to be prepared for anything. So we're not trying to predict every corner. We're trying to build a portfolio capable of navigating different and unpredictable conditions. Because ultimately, whether you're riding a motorcycle or managing someone's life savings, the objective isn't to be the fastest person on the road. It's to get where you're going and to be around to ride another day.
So, Tracey, let's move on to the Australian dollar. We've seen quite a move recently. In the last month and a half, we've seen almost 3 cents, a move 3 cents higher. So what's going on?
Well, there are good reasons for the Australian dollar to be stronger. Australian interest rates are relatively high. We are a major commodity producer at a time when the world increasingly needs commodities and energy. But I think the more interesting story developing in currency markets is what's happening on the other side of the equation, because currencies are always relative. This is a story more to do with a weaker US dollar than a stronger Australian dollar.
Yeah, and as mentioned at the start of this podcast, US government debt has just surpassed US 40 trillion for the first time. It's doubled in roughly a decade, and about US 3 trillion has been added in the past year alone.
Just think about 40 trillion for a moment. It's a number so large that it becomes almost meaningless. So here's one way of thinking about it. I carry an app on my phone called the US Debt Clock. It's a great app. I highly recommend it for all the data nerds out there. I was talking to a client about it last week, and it shows you how US debt is growing in real time. It's constantly blinking at you quite rapidly. The app is now telling me that the US government is now carrying more than $116,000 of debt for every American. And importantly, the US is running a very large budget deficit today when the economy isn't in recession. The US is approaching debt levels you would expect if they were fighting a war. So the market is starting to ask a perfectly reasonable question. Who's going to buy all this debt that the US government is issuing?
Tracey, we're seeing the bond market respond to that now. The US 30-year Treasury yield has recently been above 5.3%. That's the highest level since 2007.
And this isn't a GFC moment. The GFC was a crisis where the epicenter was corporate balance sheets. Bank balance sheets in particular were in a really sorry state. And fortunately, government balance sheets at the time were very healthy, and so they could come in and rescue the banks, which they did. This time around, bank balance sheets are very, very healthy. Government balance sheets, however, are in a sorry state. So who is going to rescue the government? The private sector will, but they want to be compensated for it. So the bond market is saying, if you want us to lend you money, we want to be paid more for taking that risk. The market is questioning the ability of the US government to service all of this debt, and quite rightly. The interest burden now on all of this, Niall Ferguson, a great historian, has resulted from paying more to service debt than fund the military. Well, the US is now there. For decades, the US has enjoyed what economists sometimes call an exorbitant privilege. Because the US dollar is the world's dominant reserve currency, there has been an enormous structural demand for US dollars and US government bonds. Central banks, sovereign wealth funds, pension funds all over the world all hold US government bonds. America therefore gets to borrow more cheaply than it otherwise would. But what happens if investors start questioning the asset they're supposed to run towards for safety?
Tracey, are we seeing that happen?
Well, I wouldn't go so far as to say the US dollar is losing its reserve currency status. I think we need to be careful there. But I can't help but be reminded of the Ernest Hemingway quote in his novel, The Sun Also Rises. And the quote is, how do you go bankrupt? 2 ways, gradually and then suddenly. And here are the facts. Private foreign purchases of long-term US bonds fell more than 40% over the 12 months to June, while foreign official investors, the central banks in Japan and China, for example, remain net sellers of US government bonds. To be clear, this is not about foreign investors abandoning US assets, because foreign buying of US equities is at record levels. So foreigners are willing to back corporates in the US, but they're less willing to back the US government at current yields. Last week, the US Treasury stepped in and announced that it would double its purchases of its own bonds. If foreigners aren't buying them, then we will, kind of thing. They hoped that the market would take some relief from that, and it did temporarily, but then it didn't. And bond yields rose again, the US dollar fell, and the price of gold jumped. The market is effectively saying, we're worried about inflation, we're worried about deficits, we're worried about how much debt you're issuing, so we want a higher return. And fair enough. The risk on the US government has increased, and so they should be paid for taking that extra risk.
And Tracey, presumably there's a feedback loop here as well. Higher yields make the debt problem worse.
Exactly. And this is a bit I think people sometimes miss. The debt itself isn't necessarily the immediate problem. The cost of servicing it is. And if I look at my debt clock app again here, it tells me at this current moment, the US government is spending $1.1 trillion just to service that debt. My app also tells me that interest servicing costs have become the 3rd largest item in the federal budget, behind Medicare, Medicaid, and Social Security. It's now larger than the amount of money that they spend on defence and war. So you get this potentially uncomfortable feedback loop. You have a lot of debt, investors become nervous and demand higher yields. Higher yields increase the interest bill, which increases the debt. The government then has to issue more debt, and investors have to absorb that additional supply of bonds. And this, one way of enticing them to do that is to increase the yield on the bonds, or reduce the currency cost of buying them. And that's why this matters for the US dollar.
Meanwhile, back home, the Australian Commonwealth Government debt hit its own milestone last week, topping Aussie dollar 1 trillion for the first time. Perhaps with an eye on what's happening in the US and previously in the UK, the Australian government is looking to make some difficult choices about spending, including the NDIS. So perhaps the question isn't simply how much governments want to spend anymore, it's how much the bond market will allow them to spend, and at what price. Now, that's all we have time for today. Tracey, thanks once again for the insights. I hope everyone enjoyed the update. And of course, we look forward to you joining us for the next podcast. Until then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.